While people danced to synth beats and watched Wall Street soar, a crisis was quietly unfolding in the world of savings and loans. The savings and loan, or S&L crisis, would ultimately cost American taxpayers billions of dollars, leaving a lasting mark on the nation's financial history. But how did it all go so wrong? First, let's break down what S&Ls actually were. Savings and loans, also called thrifts, were specialized banks designed to help everyday Americans achieve the dream of homeownership. Their mission was simple: take deposits from local communities and use that money to provide long-term, fixed-rate mortgages to families. For decades, this model worked smoothly. People deposited their savings, and S&Ls lent out money for homes, fueling the growth of suburbs across the country. It seemed like a win-win for everyone involved. By 1980, these thrifts held nearly half of all U.S. home loans, making them a cornerstone of the American dream. But then, the financial landscape shifted dramatically, a true interest rate earthquake. In the early 80s, the Federal Reserve, led by Paul Volcker, hiked interest rates sky-high to fight runaway inflation. Rates soared from under 10% to over 15%, sending shockwaves through the banking sector. Suddenly, S&Ls had to pay much higher interest to attract depositors, but their income from old low-rate mortgages stayed the same. Their profits evaporated almost overnight, and many found themselves losing money on every loan. To keep S&Ls afloat, Congress relaxed regulations, allowing them to invest in riskier ventures like commercial real estate, junk bonds, and even speculative projects far outside their traditional expertise. But as S&Ls dove into these new markets, government oversight failed to keep pace. Regulators were understaffed and overwhelmed, leaving the door open for risky bets and even outright fraud. Some thrifts gambled big and lost even bigger, racking up massive losses that threatened the entire system. Scandals like the infamous Keating Five revealed how political connections and lack of oversight led to corruption, favoritism, and fraud on a grand scale. Between 1986 and 1995, more than 1,000 S&Ls failed, devastating communities and shaking public confidence in the banking system. In the end, taxpayers were left holding the bag, footing a staggering $132 billion bill to clean up the mess and protect depositors. The government responded with sweeping reforms, shutting down failed thrifts, tightening regulations, and overhauling the system to prevent another disaster. The S&L crisis became a cautionary tale for future generations. The lesson? When banks gamble with insured money and oversight is weak, it's not just the banks that suffer. Everyone pays the price. For more fascinating stories from the world of finance, stay tuned to the Fellow Investors.